Okay, good afternoon, everyone. Welcome back to our Options Education webinar series. I hope everyone is doing well. I'm very excited to share with you this topic that is very near and dear to my heart because debit and credit spreads represent really the two strategies that allow you to understand the flexibility that options provides you with that if you're just a stock investor, you don't get. So I'm really excited to really talk about these two strategies and how they can be utilized in your portfolio to leverage the different views that you may have on different stocks or ETFs. Now, I will say before we get started, this is a more advanced topic with respect to options trading. So it does require a basic understanding of buying and selling calls and puts. So if you're brand new to options trading and you're just learning what calls or puts are or what buying and selling them means, we do have webinars specifically on the basics of beginner option strategies to make sure that you understand the concepts of buying and selling calls and puts, because today what we're going to talk about is how to combine or do a combination of buying calls and puts together that really allow you to take these different directional views but do so in a way with limited risk. Now, debit and credit spreads are very, very different from each other. It's actually not even fair, in my opinion, to actually be comparing the two because you use them in completely different scenarios. So I want to break down these strategies for those of you that are newer to debit and credit spreads so that you can better understand why and when you should utilize them. Because once that happens, once that clicks, you'll understand why you never really are in a scenario where you're deciding between using a debit versus credit spread. So because on one hand, debit spreads are one of the most efficient ways to gain a directional view or a directional exposure in an underlying ETF or stock with limited risk, while credit spreads is a very versatile strategy that allows you to take a neutral view on a stock or ETF. Something that you can't do as an equity investor is if you have a neutral view on a stock, you can't really do anything. But with options, you can sell a credit spread and actually take advantage and profit if a stock doesn't really move very much. So those are some of the things we'll go over here today. Like I said, this is a bit of a more advanced topic. So if you're brand new to options trading, I recommend that you review some of our previously recorded webinars after you finish this webinar to brush up on some basics with buying and selling calls and puts. Before I get started, just a quick disclaimer. What I'll talk about here today is purely for educational purposes. It is not a solicitation or an offer to buy or sell any specific securities. Now, a quick reminder before we get started, one of the greatest things about trading at Firstrade is that you have $0 commissions on stocks, ETFs, options, and mutual funds. And specifically for options trading, I think this has the largest impact to your bottom line because when you're trading options, typically you're dealing with smaller dollar amounts. And option commissions typically are larger than equity commissions, so you're eating away a larger percentage of your potential profits and magnifying your losses if you do have a losing trade by paying more in commissions. Only at Firstrade do you have $0 commissions on both your stocks and options compared to some of the major brokers. So a huge benefit for those of you that are looking to get started with options and trying to start with small contracts, 1 or 2 contracts, to have $0 commissions so that none of it gets eaten away by transaction costs. So let's go ahead and get started. I have a lot to cover here today. So I want to go through it as thoroughly as possible. So what I'll first talk about here today, or what I'll cover, is the difference between a debit and a credit spread. So I'll break down what debit vertical spreads are for those of you that are brand new and not sure what a debit spread is. Then I'll talk about what a credit spread is, really making sure that you understand the difference between the two before we start thinking about comparing them. Because when we compare vertical spreads, that's when we're going to dive into when is the right time to use a debit spread and when is the right time to use a credit spread. And lastly, what we'll do is we'll talk about how to trade these spreads effectively, which means how do you actually manage the entry and exits of these debit and vertical spreads. And lastly, what I want to do is actually go over to Options Play, which is the tool that you guys have access to free of charge as a Firstrade account holder that allows you to compare these strategies side by side. Because at the core of an options trader is really understanding the risks and rewards of each trade before you get into a trade and making sure that you understand that. So options play is really designed from the ground up to allow you to very quickly structure any type of option trade and quickly compare the different potential risks and rewards so that you can make a decision as to what is the right strategy for your portfolio. So today, not only do I want to make sure that you understand the strategy, but I also want to make sure that you understand how to implement and analyze these strategies using the tools that are available to you at Firstrade. So we're going to start off by talking about what are vertical spreads. There are 4 types of vertical spreads that you can trade: 2 debit spreads and 2 credit spreads. They are broken down into bullish and bearish views. So on the bullish side, you have a long call vertical, which would be the debit, and a short put vertical, which would be the credit. And on the bearish side, you have a long put vertical, and on the credit side, you have a short call vertical. Now, what I'm going to do is I'm going to break down these 4 trades so that you understand what each of these mean, and then we'll just talk about when you should utilize each one of these strategies. So first, what I'm going to start off with are the debit spreads. Those are generally easier to understand, in my opinion, for users who are newer to options trading, especially if you have a better understanding of just buying a call or a put. These are strategies that should be relatively easy to understand. Now, one of the reasons that we want to trade vertical spreads in general, or the reason that we want to even look at vertical spreads, is the fact that vertical spreads, whether it's a debit or a credit, they provide us with what's called predefined risk and reward. What that means is that before you get into a trade, you know exactly what is the potential risk of a trade and what is the potential reward of a trade, and it's capped, meaning you cannot make more or less than any of these trades. So first, we're going to talk about debit spreads. And the debit spreads simply mean that it's a debit to enter the trade and a credit to exit the trade. So like I said before, we have a bullish and bearish debit spread. So the first one we're going to cover is the bullish trade, a long call vertical. Now, a long call vertical is essentially where you're buying a 100 strike call. And this is stock XYZ trading at $100. So in this particular case, if I'm bullish on stock XYZ, I think XYZ is going to go higher. A long call vertical is where I'm going to buy a 100 strike call. So for those of you that have a basic understanding of options, buying a 100 strike call, you probably know that as a bullish strategy. And we're still going to do that in a vertical spread. We're still going to buy that 100 strike call. But what we're going to do on top of that is we're going to sell a 110 call in addition to that. What I'll do is I'll come back to the next slide to actually break this trade down for you as to why we want to sell that 110 call. And the reason for it really is because when you buy a 100 strike call, it costs a lot of money. And what you're effectively paying for is unlimited upside. But in reality, do we actually think stock XYZ is going to go to infinity? Probably not. So why should we pay for all that upside? By selling that 110 call, we're going to bring in a little bit of premium that's going to offset the cost of buying that 100 strike call. So that's really why we want to consider utilizing a long call vertical. On the bearish side, we have a long put vertical. This is where we have buying a 100 strike put. This is where we are bearish on stock XYZ that's trading at $100. We believe that the stock's going to fall in value, and one of the ways to express that view is to buy a put. So let's say we buy a 100 strike put, and then because when we buy a 100 strike put, what we're basically saying is we think the stock can go all the way down to zero. But in reality, chances are the stock's not going to go all the way down to zero in the next month or two. So why should we pay for all that upside? So what we're going to do here is we're going to sell a 90 put against that. So that is how you create a long put vertical. Now, we're going to come back to both of these strategies, but I just want to first just make sure everyone understands how vertical spreads are constructed. On the credit side, this is really where you are effectively initiating the trade at a credit, and to exit the trade, you're going to initiate a debit. So for those, you have 2 strategies. You have a bearish strategy called a short call vertical. This is where you're selling a 100 strike call. That in itself is a slightly bearish strategy. So for those of you that are new to options trading, you might remember that selling a call is a bearish strategy. So this allows you to effectively take advantage. As long as stock XYZ does not go above 100, you get to profit. However, when you sell a call, you have unlimited risk. So if the stock keeps going higher and higher, you're going to lose more and more money. So one of the ways to cap that risk is to buy a higher call. By buying that 110 call, you're capping your risk so that even if the stock goes to 130 or 140, you have limited amounts of risk that you take on this particular trade. And lastly, on the bullish side for a credit spread, you have a short put vertical. This is where you're selling a 100 strike put, and this is a bullish trade because as long as the stock XYZ stays above $100, you'll profit on selling this 100 strike put. But because when you sell a put, you have unlimited risk, what you're going to do is you're going to buy a lower put against that, and that's going to cap your risk on that particular trade. So those are the 4 trades that you can make for debit and credit. What we're going to do is we're going to analyze these strategies now to see how they actually perform. So when we're trading debit spreads, this is really the goal of the debit spread is to offset the cost of the long call or put by 10 to 20% by selling that out of the money option. So what we're doing here when we're buying a debit spread is that we're always going to buy an at the money option, so about a 50 or 60 delta call or put. And what we're always going to do is we're going to sell an out of the money option against that. And again, by selling that out of the money call or put against that, we're going to offset the cost of that long call or put by about a 10 to 20% savings. So think about the different trades that you make, whether you're buying a stock or buying a call. If you can reduce the cost basis and the risk of that trade by 10 to 20%, what is the impact to that in your bottom line? And that's really the magnification that you're going to be able to see the difference between buying a debit spread versus buying a call or a put is you're really reducing your risk by 10 to 20%, which also magnifies your return when you are correct on that specific trade. And generally speaking, when you're buying debit spreads, you want to do this with expirations that are greater than 1 month or longer. And this is the same for whether you buy a call option or a debit spread. Because you're long the option, you want to buy longer dated options because you want to reduce time decay, and time decay is always working against you. So by buying longer dated options, you're helping negate some of that time decay. On the opposite end of the spectrum, for credit spreads, this is really where you want to sell an at-the-money option instead of buying the at-the-money option, and because selling an at-the-money option has unlimited risk, to sort of cap your risk or reduce your total risk exposure, what you're doing is you're buying an out-of-the-money option against that to reduce your overall risk. Now, when you do this, generally speaking, the credit that you receive on a credit spread is usually 1/3 the width of the vertical spread. So the width of the vertical spread is the distance between the 2 strikes. So in the previous example, when we talked about having the difference between $100 and $90 put, that means the difference between these 2 strikes are $10. So on a credit spread, when you sell a 50 delta or an at-the-money call or put and you buy back a 25 delta call or put against that, the credit you receive will roughly be a third of the width of the vertical. So if you have a $10 width vertical, you should be collecting roughly about $3.33 on this particular trade. So that's the breakdown of a debit versus credit spread. So I wanted to give everyone a better sense for when you buy a debit spread versus when you sell a credit spread, what type of risk reward and what type of probabilities do you typically see? Because they are very different in nature. So when you buy a debit spread, these are trades that generally have lower probability of profit. So win rates of usually about only 40%, but they come on the back of what we consider very good risk to reward. So you're typically risking a small dollar amount to try to make a much larger dollar amount. So you're risking maybe $50 to try to make $100. So your risk to reward is fairly good, but your win rates go relatively lower when you're buying a debit spread. Conversely, on the other hand, when you trade a credit spread, this is where you have typically very high win rates. So 80%, 60, 70, 80% win rates is typical for selling credit spreads. But as a result of that, what you have is significantly worse risk to reward ratio. So when you sell a credit spread, many times you're going to risk double, if not triple, the amount of money that you can potentially make on a credit spread. So they are effectively very opposite in nature. One, you're not going to win very often, but when you win large amounts. The other one, you're going to win very often, but when you lose significantly more. So this is very different in trading in nature than most other strategies, which is why it's really important to understand, just from a mental perspective, what to expect, because some users can get very frustrated when they lose more than they win, especially when you see win rates that are 30, 40%. Some people get really discouraged when they're winning less times than they're winning. However, I will say that's on the back of the fact that you have substantially larger rewards when you do win. So just making sure that people understand that one is not better than the other, but they do, from a psychological perspective, make a difference sometimes with trading. So here's just an example of what it feels like sometimes to trade debit spreads versus credit spreads. So when you're trading debit spreads, you have fewer winners with larger rewards. So in this particular case, let's say we have a win rate of 40%. You may have trades where you have one winner, two losers in a row, and then another winner, and then another loser. So three out of the 5 trades you make are losers. And the net result of this is you gain about a $50 profit on this particular trade. So that's sometimes what it feels like to trade a debit spread, versus when you trade credit spreads, you might have 3 winners, 3 out of 4 winners in a row, 3 or 4. So as you can see, I have 4 winning trades where I won $50, and I have 1 losing trade. So only 1 losing trade out of 5. But as you can see, my 1 losing trade typically will risk substantially more than what I'm winning. So my net result is the same between these two, between this and this. So that's why it's really important to understand, even though you have very different paths, many times you end up with very similar results. So keep that in mind when you are utilizing these types of strategies, that they are very different in nature, but at the end of the day, they are not as different, even though it might feel that the path there is very different. Now that we talked a little bit about what debit spreads are, what credit spreads are, what it feels like to trade these types of strategies, I want to now address when you should actually utilize these strategies. So they are very, very different in nature. So it's really important to understand when are the ideal conditions to buy a debit spread and when are the ideal conditions to sell a credit spread. And I have a few different examples to show you with some real stocks to make this point a little clearer. So number one, when you're trading debit spreads, this is only for when you expect a large and quick move in any direction, whether you think a stock's going to move higher or lower, but you expect a large and quick move. So this is typically for a lot of you that use charts. Maybe you've identified a breakout or breakdown. So a stock has broke a support or resistance level, or maybe it's bounced off of support and resistance level and you expect the stock to make a quick and fast move. That's when you want to use a debit spread. They are also generally better for lower volatility environments. But the key here is that only when you expect a large and quick move should you utilize a debit spread. On the credit spread, on the other hand, this is really useful when you expect a neutral or modest move. So think about stocks that have hit an overbought or oversold condition where you basically think that, hey, the stock has maybe rallied 10, 20% in the last couple of weeks. You don't really think it can go much higher. You think it might pull back a little, but you don't think it's going to go any higher. Those are ideal conditions to sell credit spreads. Or maybe a stock just got plummeted on earnings or really took a deep dive over the last few days, and you think that that move is done, and you think maybe it's starting to form a bottom. You found some support. Those are also ideal conditions to sell a credit spread. These are generally better for higher volatility environments. So very, very different in nature and really should not be compared to each other because you are utilizing them for very, very different perspectives. So more illustrative view as to kind of thinking about debit versus credit spreads. I have a chart here of a stock that really traded within a pretty big range and started to trade in a tighter and tighter range into a triangle before it started to break out. Once you saw that breakout, this is really where we would anticipate a fairly large move, because breakouts typically, especially on a triangle like this, you will typically expect a move roughly the size of the beginning of the triangle. So this went from 103 to about 95, about an $8 move. And that's exactly what we saw here, about a $7 move from here to here. So when you expect these types of quick and fast moves, those are ideal conditions for a debit spread. On the other hand, credit spreads are for when you expect kind of a stock to kind of trade within a range or constantly bounce between overbought and oversold. So whenever it becomes an oversold, those are a good time to sell a put credit spread. And when they're overbought, that's when it's time to sell a call credit spread. And notice that on this particular chart, I only have one opportunity to trade a debit spread versus I had multiple opportunities to sell credit spreads on this same stock. And that is also another fundamental difference between selling credit spreads versus buying debit spreads, is that debit spreads, you're typically going to be trading different stocks all the time because these types of opportunities do not come all the time on the same stock. Versus credit spreads, many times you might find yourself trading credit spreads on the same stock over and over again. So very, very different trading strategy and very, very different way of going about utilizing these types of strategies. And I hope that this illustrates for you sometimes as to when is the best time to utilize these types of strategies. So lastly, what I want to talk about is how do you manage these trades, meaning how do you actually manage the entry and exit of a debit and a credit spread. So for a debit spread, this is really where you want to time your trades when you expect a quick and fast move. So you only want to enter these trades when you expect that large move to materialize. So in the previous page, when I showed you that chart, only once you see that breakout, that is when you want to enter a debit spread. On the exit of a debit spread, this is part of why I find trading debit spreads relatively easy, because to manage them, they're pretty simple to manage. Versus credit spreads, it's a little bit more involved. When you're trading debit spreads, the rules are pretty simple. You always want to exit the trade before expiration, either at a gain or a loss. Now, this is true whether you're buying a debit spread or if you're just buying a call or a put. When you buy a call or a put, you don't want to hold that to expiration. You usually want to exit it before expiration, either at a gain or a loss. Now, one of the things about a debit spread is because we only trade this when we expect a large move, if the move doesn't materialize, you should cut your losses and move on. That is one of the rules for managing a debit spread. Because a debit spread, you've basically said, I think the stock's or maybe the stock breaks above a support, breaks above a resistance level, or maybe breaks below a support level. If it happens and then the move doesn't really materialize, it just fizzles out, cut your losses, move on. And the rule for cutting losses on these trades are pretty simple. On a debit spread, it doesn't matter what type of debit spread you trade, you want to cut losses if you've lost anywhere about 50% of what you paid for that debit spread. And you want to take profit once you've made anywhere from 75 to 100% gains on that debit spread. And if you are trading multiple contracts, you would want to at least take partial profits at those levels and maybe maintain a portion of your trades for additional gains. But the rules for managing debit spreads, generally speaking, are pretty straightforward. On the credit spread side, this is where it gets a little bit more involved, but it's still manageable, I think, for most users. So when you're selling a credit spread, you want to time your entries and with market tops and bottoms. So think about any of you that use technical indicators like RSI or MACD or stochastics. These are indicators that tell you overbought and oversold conditions. So those are ideal for telling you when it's the right time to enter or enter a credit spread. And you can string puts and calls together, meaning you can have a stock that's overbought one day and 2 weeks later is oversold. And you can be selling a put credit spread 1 week and 2 weeks later selling a credit spread on that same symbol. That's something that you can do on credit spreads that you're typically not going to do on a debit spread. As far as managing credit spreads, the goal of a credit spread is to hold that trade till expiration. So unlike a debit spread, when you sell a credit spread, the goal is to actually hold that position to expiration, and you want it to expire worthless. That's the main goal of selling a credit spread. However, we generally find that there are some rules where you might want to take profits early. So if you gain 50% of the gains with more than 2 weeks left to expiration, that is generally a good time to consider taking profits. So most credit spreads that you sell are usually no more than a month out. So if you have still more than 2 weeks left till expiration and you've already made more than 50% of your profit, it's time to take profits early. Because when you're selling credit spreads, you're risking more than what you're taking in for income. If you've taken in that income quickly, you want to make sure that you take profits, because that can evaporate pretty quickly and you can give up a lot more than what you received. Now, as far as cutting losses, this is where it depends. Now, I talked about the vertical width, which is the distance between the two strikes. If the premium that you collect on a credit spread is greater than 1/5 of the vertical's width, then you want to cut losses where you've lost anywhere from 75 to 100% of the premium that you received. However, if the premium that you received on a credit spread is less than 1/5 the vertical spread, that's when you want to cut losses anywhere from 100 to 200% of the premium received. So it gets a little bit more involved because when you're selling credit spreads, you can sell really far out of the money credit spreads where the premium you receive is smaller than 1/5 the value of the vertical width. If you do this, you generally want to give yourself a little bit more wiggle room before you have to cut your losses. So again, credit spreads are a bit more involved, a little bit more advanced as a strategy, so it requires a little bit more understanding before you can manage these properly. But those are some of the rule of thumbs that we typically follow when we're managing credit spreads. So with that, what I want to do is I want to jump over to options play. I want to show you some real stocks with some potential moves that are about to happen, and I want to show you how you can, compare buying a call or a put to the debit spread versus the credit spread, and really show you the difference between the different strategies. So with that, what I want to show you is options plays. For those of you that are brand new to Firstrade or brand new to options play, you can launch options play by going to your home screen and clicking on the options wizard, launch options wizard thing on the right-hand side of your screen. When you click on that, it's going to launch options play. It's a free tool available to everyone with a live trading account. And this tool is designed to make your options trading experience as simple as possible. Compared to using an options chain, which looks like this, where you have pages and pages of expirations and strike prices and lots and lots of numbers that may not mean a lot to you. And even if you do learn how to use pages like this, setting up a debit or credit spread by using pages like this requires a lot of mental math that even if you are a professional, like I used to have to do a lot of this mental math in my head, still puts me at a lot of disadvantage compared to tools that really allowed me to do this, because it was really difficult to compare one credit spread against another credit spread, or a credit spread against a debit spread, or one expiration against another one. Options play is designed from the ground up to really take that complex user experience out of the picture and make it as easy as possible for anyone to structure different trades and quickly see the potential risks and rewards before you decide whether this is a trade that you want to make. So the first one I want to look at is Boeing. And I'm looking at Boeing because I think everyone's fairly aware of what's happening in the news with Boeing. As the stock certainly took a plummet since that news event, but recently has rallied quite a bit over the last week or so back to this, what I would consider a fairly major support or resistance level around 360 or so. It dropped a little today around 352, which really, to me, also confirms the fact that 360 is a major resistance level. And from my perspective, I think there's probably more downside, at least to maybe 335, possibly even 320 to the downside in the immediate future. So clearly a bearish trend in Boeing. I feel that the fact that it had a small rally back up to 360 and got rejected off of that is a good sign that perhaps the stock is going to continue lower. So because I expect this is effectively a rebound off of that resistance level, I would expect that I'm going to expect a quick and fast move to the downside. So remember, quick and fast moves are good for debit spreads. Now, options play will automatically find a debit spread for you. So when I select I'm bearish on Boeing, the tool will select shorting the stock, buying a put option, which for those of you that are new is a simple option strategy to take a bearish view on a stock. And it will also select that debit spread for me. So the put option it's telling me to buy is the June 28th 355 put, which is effectively an option that's about a month and a half from expiration. It is the at the money strike, about 355 strike. And the debit spread, what it's doing is it's also buying the 355 put, but it's also selling the 325 put against that. So what this allows me to do is very quickly look at what it looks like to buy a put versus buy that debit spread. So shorting the stock would cost me a substantial amount of money to do so. Buying a put option cost me $1,200. Buying that debit spread cost me $964. What I'm doing here is I'm still buying that 355 put here for the 1245, but by selling the 325 put against that, I'm going to collect $2.81, which reduces my overall risk from $1,200 to $964. And as you can see in the next few minutes, as I use my P&L simulator, that by reducing my cost by about $300, it's going to magnify my returns when I am correct. So lastly, what I'm going to do is I'm going to replace this short stock position because I don't want to look at shorting the stock. What I want to compare it to is selling a credit spread. So let's say I'm going to create a credit spread, which I'm going to use my strategy constructor here. I'm going to select bearish, short call vertical, and I'm going to select a credit spread here that would allow me to effectively take advantage as long as Boeing stays around this 360 level. And to compare these three strategies side by side and compare apples to apples, I'm going to use our risk and investment calculator, which allows me to say I'm willing to risk, let's say in this particular case, $3,000 on this particular trade. If I'm willing to risk $3,000 on this trade, it'll tell me to sell 2 contracts of the credit spread, buy 2 contracts of the puts, or buy 3 contracts of the debit spread. And as you can see, each one of these strategies risks roughly about $2,500 to $2,800. So I have the equal amount of risk for each one of these 3 strategies. So now I know I'm comparing apples to apples. And now let's see, Boeing's at 352 right now. Let's say in a month or a month and a half from now, the stock's stating where just where it is, around 350 or so. As you can see, if it's at 350, as you can see, only the credit spread makes me money because the credit spread is the only strategy that allows me to take advantage of a stock being neutral. If I bought a put or a put spread, I actually lose money if the stock stays neutral because a put and a put spread requires the stock to make a quick and fast move before these strategies are profitable. So if you have a neutral view on Boeing, you don't think it's going to move any lower, selling that credit spread allows you to collect a $1,600 reward while risking $2,800. So that really is the tool. This is one of the benefits or flexibility of options or credit spreads provide you with, is even if the stock doesn't move at all, you can still make a profit. However, in this particular case, I do believe that Boeing is going to move lower because of the news that's coming out, because of the potential fallout that I think will happen on this particular stock and the risk that they may have to pay for some of the litigation costs for the crashes. I don't think that's fully reflected in the current stock price. So let's just say the stock tests that 335 recent low, which I think would be a very conservative target to the downside. As you can see, if the stock even moves down just that $15 or so, on the credit spread, I still make the $1,600, but on the put option, I make $1,500. So these two are fairly comparable in this particular case if the stock declines to 335. But notice what happens here on the put vertical, on the debit spread. If this stock declines to just at 335, I make $3,100. So roughly double what I make from the put or the credit spread. So that's why this debit spread here on the right is, again, why we think it's one of the most efficient ways to take a directional view on an underlying stock with limited risk, because I'm risking the same amount as I am on the puts and the credit spread, but if the stock moves even mildly lower, I'm going to collect roughly double the profits that I do with any of these two strategies. And notice how if the stock moves any lower, so we have a support here around 322, which goes back to the December lows. So if this goes back to 322, as you can see here, I only collect the $1,600 on my credit spread. On my put option, now I make a $4,100 return. So almost triple what I would make on the credit spread. So again, credit spread's only useful when you expect a mild move. If you expect a big move, it's not a very efficient deployment of your capital. You're much better off either buying a put or a put spread. So if I bought the put, I make a $4,100 profit. On the put spread, I make a $6,100 profit. So for the same amount of risk, I'm going to make almost quadruple the amount of money on the debit spread than I do on the credit spread. So again, this is part of why I don't believe that people should really be comparing debit to credit spreads, because they're really useful for completely different views. So if I expect Boeing not to move very much, I would sell the credit spread. If I expect to move even mildly lower, I'm much better off buying that debit spread. Let's move on to another example. I want to look at Apple. Apple is one of those stocks that really has taken a hit as this trade war and tariffs rhetoric that we've had is really taking a beating on this particular news. And partially because Apple has a lot of exposure to consumers in China, and trade wars are certainly not helping. And now that we've brought technology companies and Huawei into all of this, it just muddies the water even further. And I think that the longer this stuff drags on, the more likely that Apple may decline. Now, because there isn't a strong catalyst, in my opinion, for Apple to move lower, I do believe that it'll be more of a slower grind to the downside than a quick and fast move. So let's take a look at a few different examples. So same thing, when I click on I'm bearish, I can short the stock, I can buy a put, I can buy this put debit spread, but instead what I'm going to do is I'm going to modify this short put. I'm going to create a credit spread instead, and I want to take a look at what happens if Apple just takes a slow move to the downside, how these strategies compare. Again, before I compare them apples to apples, let's say I want to risk $2,500 on this trade. So I can sell 2 contracts of the credit spread, buy 3 contracts of the puts, or buy 4 contracts of the debit spread. And as you can see, roughly across the board, I'm risking $2,500. Let's increase this maybe to $3,000. So here I'm risking $2,800. Here I'm risking $2,400. Here I'm risking $2,400. Roughly in the same boat. 3 contracts, 3 contracts, 4 contracts. So let's take a look. Apple's trading at 182 right now. If I think Apple's just going to stay around this 180, 182 level or so, as you can see, it's got some pretty major support around 180. If the stock stays around 180, the credit spread pays me the full $1,600 credit. So I make all the money as long as the stock stays pretty much right where it is near its support level. Again, so if I'm expecting a neutral move, credit spread really allows me to take advantage of the stock not moving anywhere. If I bought the put or I bought the debit spread, I would lose money because, again, these 2 strategies require a quick and fast move. And the stock staying where it is not a quick and fast move. However, if the stock starts to grind any lower to maybe 175, that's when, as you can see, in this particular case, I actually still make more money on the credit spread. A $1,600 return, only a $585 profit on the puts, a $1,500 profit on the debit spread. So even if the stock grinds a little bit lower, I'm still better off trading the credit spread. So this is really where I have to ask myself, how bearish am I on Apple? Do I think the stock's going to make a significant move lower? Is it going back to 169 or maybe even lower to 150? If I do think it's going to make those types of moves, then yes, I want to buy that debit spread. But in my opinion, I think Apple's probably going to be more of a slower grind to the downside. So I would probably be more inclined to trade the credit spread in this particular case because it's more of a neutral view that I have on this stock. A slightly bearish, but more neutral view than I would require for me to buy that debit spread. So this tool really makes it really easy for you to compare any type of strategy, whether you are comparing complex strategies like debit and credit spreads or very simple strategies like puts. Maybe you just want to buy some puts. Maybe you don't want to get into all of these complex debit and credit spreads. Maybe you just want to compare buying a 180 put versus a 185 put. That's a very simple thing that I think a lot of people want to do, is saying, well, if I just want to know which strikes should I buy. So this allows you to very quickly say, well, if I think the stock's going to move down to 175, then the 185 strike is going to be a much better return than buying the 180 strike. But if I think the stock's going to make a move down to 169, then as you can see, perhaps between the two, you have a fairly similar return. And lastly, if I do think there's going to be a quick move to the downside, then that's really when the buying the out-of-the-money puts are better. So this tool allows you to structure any two trades side by side and instantly see where you get the best return. I'll do one last example before I open this up for Q&A. I was looking at Phillips 66 today yesterday rather, because energy has really been one of the stronger sectors as the market has really sold off. This stock has taken quite a beating over the last couple of months, if you will. What was trading at just 100 here in April, and now it's really tumbled down to 85. But from my perspective, it seems to have found a bit of a bottom here around 85 or so. And what I'm basically expecting is that this is a temporary bottom in this stock. I don't know that it's going to move significantly higher, but I certainly don't believe it's going to make a move below 85, because as you can see, it's really tested 85 multiple times and bounced off of it. So this is an example of an oversold stock, where I feel that it's reached a bottom, and I don't think it's going to move any lower, but I also don't know that it's going to move significantly higher. So those are an ideal situation for selling a credit spread. So here I'm going to set up a credit spread. Let's say I want to look at selling this credit spread here. This allows me to quickly identify some strikes that might make sense and compare them to buying a call or buying a call spread, which if you were more bullish on the stock, the call or call spread makes sense. Let's say in this particular case, I want to risk $2,500. So here I can sell 8 contracts of the credit spread, buy 8 contracts of the call, or buy 10 contracts of the debit spread, each one of these risking roughly $2,500 or so. So let's compare these strategies side by side. So like I said, 85 I think is a support level here. So if the stock stays just around 85 or hovers just above 85 or so, my credit spread will pay me the $880 while risking the $2,300. The only strategy that will provide me any returns or any positive returns if the stock just stays where it is. And that's, again, the benefit of selling a credit spread that you're not going to get when you're buying a call or a put, that require a call or a call spread, because that requires the stock to make a quick and fast move. Now, if instead the stock does rally up to $88, which is where it was just at last week, as you can see, still credit spread, $880 profit, versus on the call, I'm losing $240. So even if the stock rallies $3, I'm still going to lose money on the call option. On the vertical spread, I'm only making $100 while risking $2,400. So even if the stock rallies up to 88, not going to make me much money. So which is why in this particular case, if I believe Phillips 66 is just sitting around this 85 level, it's a support level, I don't think it's going to go much lower. Selling that credit spread allows me to profit from the fact that it's not going to break its support level. And as you can see, the stock really needs to rally back up to probably around 92 or so before this strategy becomes interesting, or maybe even $90. Yeah, so as you can see, the stock needs to rally back up to about 90 before these two strategies start to outperform the credit spread. So many times you can utilize this type of tool to ask yourself, well, do I think Phillips 66 is going to rally back up to 90? Because if I do think it's going to rally up to 90, then I'm better off trading one of these two strategies, versus if I'm not as bullish on it, and I think it's only going to rally maybe up back to that 88 level, then I'm better off selling that credit spread. And this tool gives you the exact details that you need to make the decision as to whether you want to have a more of a neutral view on a particular stock, or you have a more stronger directional view that really allows you to profit from it. And this tool allows you to understand what is the right option structure to be able to profit from those views. And this is really one of the greatest innovations that we've created here at Options Play, that allows anyone to structure any trade and immediately see apples to apples which strategy gives you the best return and allows you to get the best return for the same amount of risk that you're taking. So I hope that this was illustrative for everyone and informative to really inspire you to take a look at some of these more advanced strategies such as credit and debit spreads. I know many of you are just learning some of the basics of options trading, and I don't expect everyone to be able to finish this webinar and just start trading debit and credit spreads, but I hope that this inspires you to learn more about trading basics of options so that you can graduate to some of these more advanced strategies that really allow you to take these strong directional views with limited risk, because it really shows you the flexibility of options so that regardless of what views you have on the stock, you can leverage options to create a profitable strategy, even if you think the stock's not going to move at all. So with that, what I'm going to do is I'm going to open this up for Q&A. If you have any questions regarding anything that I just expressed here regarding credit or debit spreads or even buying calls and puts, please use the chat window or the Q&A window and type in any questions that you have, and I will try to take as much time as I can to answer your questions regarding the options strategies that I expressed here today. So let's jump over to the questions here. Larry is saying, would you mind explaining vertical width again? Absolutely. Vertical width is simply the distance between the two strikes. So in this particular case, in this credit spread, I'm selling the 85.5 puts and I'm buying the 81.5 puts. The distance between these two strikes are $4. So the width of this credit spread that I'm selling is $4 wide. So that's what the vertical width refers to, is simply the distance between the two strikes in dollar amounts. What do you think about using this method for VXX or VIX? So you absolutely can utilize these strategies for VXX or VIX. The only question I have for you is, how do you typically determine your directional views on VIX, on VIX or VXX? If you have a strong directional view, you can express them using strategies like this. Pedro's asking, if both legs expire in the money, do we get put or exercise the stocks? So Pedro, that depends on whether we're talking about a debit or credit spread. But if they're both in the money, then the short leg will get exercise. So if it's a call, then you'll have to deliver the shares. If it's a put, then you have to purchase the shares. But that depends on the trade, right? So on a debit spread, you generally do never hold a trade till expiration. So that shouldn't really be a problem. It's really only a problem on credit spreads. So you should monitor your credit spreads. So if you're in the money on expiration, you want to close it out if you don't want to have to deliver or purchase the shares. Jacob is saying, credit spreads, you'd like to take less than 30 days. Can you compare it to others? Absolutely. So if you want to compare a Phillips 66 June 28th, which is 37 days from expiration, and you want to compare it to a shorter dated option, let's say a 23-day option, you can do them for the same strikes if you'd like. You can do this very, very quickly using our tool. Looks like there's no 85.5 on the June 14th, but you can utilize this tool to compare any two strategies side by side. So you can compare different strike prices, you can compare different expirations. You can do this all using this tool. And this tool, again, we call it Options Play because we want you to play around with the different strikes and expirations and see and explore. That's why we created this, and we made it as easy as possible so that you can move all the strikes up or down one just by the click of a mouse. You can make it wider or narrower just by the click of a mouse. You don't have to always just use drop-down menus constantly to try to find all the different strikes that you want. You can use the drop-down menus, but I tend to find it's easier to navigate by moving the strikes up or down one just by clicking a mouse button. Richard's saying, does this take into consideration open interest? It does not take into consideration open interest because open interest is really not a useful metric for trading. Open interest just tells you if someone else traded these strikes. It has no impact as to you trading these strikes. So I tend to find that a lot of people tend to put some weight behind open interest. I hear users stay away from trading stuff that has zero open interest. Don't be afraid of trading something that has open interest because it has nothing to do with, if you look at an option chain, there are thousands of strikes. That just means that if someone else happens to trade the same strike as you do. Here's an example. Let me go over to a name like Goldman Sachs, one of very, very liquid name, obviously. Let's go out to maybe the Junes or Julys. Notice how here the 190 strike has 2,700 contracts of open interest, and the 187s have 0. Is the 187s any less liquid than the 190s? Absolutely not, because it's Goldman. But because it just happens to be no one wanted to trade that odd strike. So open interest has nothing to do with liquidity. Don't let open interest stop you from thinking about trading something. Obviously, people like to trade round numbers. So the 200 strike has 5,000 of open interest. The 202.5 have 0. The 205s of 2,400, the 27.5 have 0. These are not any less liquid than the other strikes. It just happens to be that people like to trade round numbers. Jules, would you trade options like these on SPY or Qs? Absolutely. When you're trading these particular names, it doesn't matter whether you're trading an individual stock or ETF. They work the exact same way on an ETF as they do on a stock. Pedro's asking, is the volatility simulator and the P&L simulator based on point of options entry or based on exit? It's based on your exit. So if you are to let's say you believe that a volatility is going to collapse because maybe there's an earnings date, or you think volatility is going to come up because of earnings, you can basically say that, well, if on a certain date volatility is going to be lower and the stock is going to be higher, how much profit am I going to receive on the exit? That's what the volatility slider allows you to do. Claudio is saying, in creating advanced strategies, I've heard of multi-step 30 option that can be managed for an up, down, flat move for a profit. Is that the unicorn option? Claudio, I'm not sure what you're referring to. If you could possibly elaborate on that, I'm happy to take a look. I think what you're basically saying is as an option strategy that will make money in all market conditions. In theory, they exist, but in actuality, I don't know that you'll ever be able to execute one of those trades. Angela, once you hit trade on options play, it goes to Firstrade and automatically will populate, but still ask you which limit type you want to use, credit, debit, or net price. Can you explain how to select the limit price? So a debit is so here, this call vertical here is a debit of 240. This credit is a debit of 880. So when I click on trade and preview order, it will pre-fill the credit here. So you can fill in how much you want to receive on that credit. So this is one of the things that you have to think about when you're selling credit spreads, is how much credit you want to receive. So let's see. Let me go back to options play on this particular trade. So if, let's say, this trade is a 210 debit, then when I hit the trade button, you would want to make sure that you select debit, because it will always input this price. Now, one of the things I will say is that you can't really screw this up, because you will never get filled on a credit for a debit trade or vice versa. So even if you enter these incorrectly, it will never get filled. So you just want to pay attention to when you're looking at the trade on options play, whether this is at a credit or a debit. So when the trade cost is a positive number, that's a debit. When it's a negative number, it's a credit, so that when you go over to the preview order button, you know to select either credit or debit. That's a really good question. And this is some of the functionality that I think we are helping Firstrade improve upon, is this debit versus credit, so that you have a better understanding as to where to place those orders. Stephanie's asking, are there strategies to repair a losing spread? Here's my philosophy on that. Certainly there are ways that you can try to repair a losing trade. However, what you're effectively doing is taking on more risks just to try to get back to break even. And from a trader's perspective, I never recommend people to take on more risks just to try to get yourself back to break even. Because if you get into that mindset, you are potentially digging yourself a bigger hole. You're much better off cutting your losses and moving on to that next trade. I personally do not believe in doubling down, because every time you double down, you're taking on more risk, and you are potentially digging yourself a bigger and bigger hole, because there's nothing that stops that repair trade to lose even more money. And sometimes you find yourself going down these rabbit holes where next thing you know, you've risked 10 times the amount of money that you originally intended on risking. You're better off just cutting your losses, moving on to the next trade. That's my philosophy with trading. And that's more of a risk and money management. That has nothing to do with options trading and what I think of your options trade per se. But the one caveat I will say to all of that is if you're in a losing trade and you're thinking about putting on a repair trade, ask yourself, would you put on that repair trade if you weren't already in a losing trade? 9 out of 10 times the answer to that question is no. And that's why you shouldn't trade that repair trade. If in that 1 out of 10 times you would have put on that repair trade, even if you weren't in a losing trade, that would be the only time that I would even consider it. But I generally find that 9 out of 10 times, if not 99 out of 100 times, the answer is going to be no. I would never have traded another trade on that same name if I wasn't already in a losing trade. So that's my take on repair trades. When you hold the vertical spread, do you always exit the spread together? Yes, you always exit the spread together. You generally don't want to exit with 2 single legs. You can, I will say that because you have $0 commissions at Firstrade, you're not incurring any additional transaction costs, which is something that most other traders at other firms have to worry about. But generally speaking, these strategies are meant to be traded as one, not separately. Are there any other questions regarding anything with debit versus credit spreads? Can we set exits based on profitability? Yes, you can set stop and limit orders on your option prices. Yes, you can do that. If there are no other questions, I just want to thank everyone for taking the time out here this afternoon. I know this is a bit of a more advanced topic, but for those of you that have some more trading experience, I hope you found this useful in making sure that you guys really understand the power of options and what you can utilize options play to do to structure these trades and better understand these trades, because they really allow you to take these different directional views that you may have on different stocks and ETFs and leverage them in a way that you wouldn't be able to if you were just an equities trader, especially when you expect a quick and fast move to be able to take advantage of that with a high amount of leverage but still have limited risk, or if you just have a neutral view on an underlying stock and how to be able to express that in a way that you wouldn't be able to if you were just an equities trader. So with that, I really hope you guys have found this useful. Thank you so much for taking the time out here this afternoon. I will be back here in 2 weeks again to do more webinars for you guys. This is really designed to make sure that you guys have continuing education for various option strategies across basic and more advanced strategies like the one we covered here today. So I hope everyone found this useful. I hope you have a great afternoon, and I'll see you guys in 2 weeks.